Hi there, welcome to my weekly fundamental video. So yeah, we're going to start off by looking at the my difference indicator, and yeah, this is for the S&P 500 and UK 100, FTSE 100 if you like. And yeah, we started off the week previous to last, this is the Friday, just as a date for relative comparison and everything. And this is the Friday just gone here, Friday. And as you can see, we opened slightly worse. Yeah, and then since then we've been moving fairly same. We haven't really done too much. We came a bit back together at the end of the week. But that's not to say there isn't much news. In particular, BRE, Bank of England, which we'll come onto in this video. And we've also, and now to look at the GR30. The DAX if you want, and we're going to be looking at this in the video. But as you can see from that Friday the 30th, we moved fairly far apart, and then we came back closer together. So we're going to look at what caused all of this and everything. So yeah, this should be an interesting one. But first, yeah, I did a little exploration into the current fears around bond liquidity and what's been going on. You know, the general fears around that. And I'll explain that more next, but I was just looking at it for myself, just interestingly, because I was interested, sorry, because, yeah, just to see what's happening and everything, and I thought I'd share some of the results with you guys, as I think you might find it helpful and interesting. So, yeah. We'll come on to this graph in a second. I'm just going to talk you through what the scenario is, a bit of context. Yeah, So what are we looking at? So what there's fears about is the bond cash market. Now the bond cash market is where you use simply one's own money to buy bonds, or you use, maybe if you're a larger trader and you have depositors, you use their money to trade with, or to buy bonds in this case. Now there's been arguments from big trading houses such as banks that the regulatory requirements imposed on these trading institutions have made it so there is a shortage of liquidity. Now what liquidity is? Liquidity is the ability to easily buy and sell an asset. So an example of a very liquid market would be the pound dollar, for instance. If I wanted to sell the pound and buy dollars, I could do it pretty much instantly on eToro. It's one click of the button and it's all done. I just have to tab in my stop losses, take profits and everything, maybe a bit of leverage. But as soon as I click OK, it'll be transferred pretty much instantaneous. Now a more liquid market is something like houses. So if I wanted to sell my house, it's not as easy as me clicking a button and selling it. You know, people have got to come and view it. I've got to get, you know, maybe a few lawyers in to do all the tax and accountants and so on and so forth. You know, it takes a bit of time and everything, so that's it's more liquid. So it's the ease that you can buy and sell something, or the speed rather. It's more based on speed, but ease is another way of describing it. So yeah, the banks have been saying that regulatory requirements have made it less easy or less quick to buy and sell bonds. I mean, so what's their arguments? What is the regulatory requirements that are causing this? Well, the first one that surrounds proprietary trading. Now what proprietary trading is where a trader trades stocks, bonds, currencies, commodities or their derivatives with the firm's own money as opposed to depositors' money, so as to make a profit for itself. So basically, instead of using depositors' monies like big trading houses might do, so they search for clients, big investors, and then they use that money to you know, buy bonds. Instead, they used to be the case that they could also use their own money. So they could just, if they had £10 million, they could just buy 10 million of their bonds and just hold that, and then use their depositors' monies to buy other things. And you know, their capital is fairly safe because they're in bonds, and they're using the depositors' monies to take a bit more risk and overall increase the profitability of the firm if everything goes right. That is. But it didn't go all right in 2008 or during the run-up in 2008, and that's why these rules have been implemented. So firms, big trading houses, banks, so on and so forth, can't use their own money to buy bonds. There are really good reasons for this, but obviously, if you're looking after your own self-interest, and I think banks are going to, want to establish this as a problem. Yeah, but we're going to find out if it is a problem. And this also relates to capital rules. Now, banks once again have been banging on again about these, but basically these are that instead of using profits and everything to proprietary trade as discussed before, they have to use it to shore up capital. So they have to have a certain amount of capital as risk, basically, in case of a market sell-off, in case of failure. So they have to have money to plug holes or to support the institution in general. So yeah, those two big reasons is what they say is the cause of a potential liquidity crisis, basically. Yeah. So what's the argument is that these two causes have two examples, proprietary trading and capital requirements, have caused it so the markets have become less liquid. Because they can't hold so many bonds, they don't have the capital because they're using it to shore up the capital requirements, and they don't have the ability to use their own money to buy bonds with. And overall, this stops them market making. Now, the definition of a market maker is a broker firm that accepts the risk of holding a certain number of shares of particular security in order to facilitate the trading in that security. Each market maker competes for customers' orders flow by displaying buy and sell quotation for a guaranteed number of shares. Basically, a market maker holds a huge number of bonds, or maybe not huge, an appropriate number of bonds, and so on and so forth, so that when people buy and sell, they can just meet that demand or that supply as such. They can just sell it and buy it. And once again, they say that the capital requirements and the proprietary trading, the stopping of this, the kind of regulatory demands, is making it so they can't do this. So is this affecting the markets? And now this is basically, this shows the volatility of the bond market. And what I've got here is the orange line is the pre-crisis level. So this is between 2006 to 2007. This is the volatility in the bond market, the orange one. And then I put the blue one behind it, and the blue one is today. So this was 2014 to 15, and it was from the 20th of Feb 2014 to the 20th of October 2015, and the 20th of February 2006 to 20th of October 2007. And what can you see? These points are just percentage change. Is how much did the price of the bond change from one day to the next. And as you can see, the percent change of the bonds has grown markedly. The blue lines are all the way up here, and yeah, all the way up here. These are the orange is just squashed in. So there has become more volatility. So how does this relate? This volatility relate to liquidity crisis? Well, the answer is because demand and supply is not matching, and this gives support to the big trading housing and the firm's argument that there could be a liquidity problem. Because basically, what's happening is where maybe, let's take here for example, maybe someone sells a bond here, the price rises to here to find a buyer, but someone likes it there, so they buy it. So it's not having to move that much to find new buyers and new sellers. Whereas now it's having to move markedly. It's having to find new buyers and sellers to meet the original demand and supply. It's really having, the price is really going to have to change. And what this is telling you is there's a problem with demand and supply, causing there to be bigger fluctuations in price. So yeah, then that poses a problem, because the Federal Reserve are looking like they're going to be raising their rates, especially after the last NFP's the Fed probability for December is 70%. So this could pose a problem. You know, people are going to want to maybe get out of bonds, and if loads of people want to get out of bonds, they're not buying. Everyone's selling, and no one's going to buy the bonds from the people selling. Then the yield, so it's just going to rocket, and the price is going to plummet because they move inversely. Yield goes up, price goes down. So what's the effect of this? Well, it's going to be, you know, bond prices, if that happens, our bond price is going to tumble and yields are going to go up, and this can have ramifications to equity markets. I mean, ETFs, for instance, buy both, some ETFs buy both equities and bonds. Now, if you're invested in one of those ETFs, which quite a lot of people are, ETFs are quite popular, and you decide to pull your money out because you're scared about the bond, that means the ETF holders are going to have to get some money themselves to meet the pullout. Now, if no one can sell, if everyone's selling bonds and no one's buying them, they're not going to be able to sell their bonds, are they? They're going to have to sell the equities they're in. So then that's going to have ramification to the equities, and we could see a potential big sell-off in equities as well as bonds. So that's something to watch. And I started off with that video just because I researched that, and although it's not really playing out on the markets at the moment, it is an underlying concern. And if we do see it happen, it's going to cause some big problems, you know, down the line. It could make the recent China thing look like a bit of a doddle, or it could just be a bit of a replication of that. So we'll see. But yeah, we're going to move on to the news from this week now anyway. But I hope you found that helpful and everything. If you have any thoughts on this as well, any questions, please ask. Yeah, so let's move on. So we're moving on to VW. Now, the reason we're moving on to VW is because the scandal continued to spread this week. It spread on Tuesday through Wednesday. That's when most of the news came out on it. So as you can see on Monday, this is the VW close price. It actually closed higher relative to the point it closed on Friday. Then bang. Bang. Pretty simple. The reason the VW scandal spread is it went to their sports utility vehicle range. It uncovered that thousands of these vehicles were failed. Sorry. VW failed for these vehicles. Sorry, the sports utility vehicles. VW had failed to acknowledge the first time the story broke that these vehicles had defeat devices attached to them. Yeah, and the vehicles that were found this time to have defeat devices on them had 9 times the nitrogen oxide levels that the requirements say, like the EU law requirements. So it's pretty big. It's another scandal. It isn't making VW look very good, and you've got to remember that VW are a bit of a luxury brand. They try and advertise themselves as the best, the top range, you know what I mean? Like, their car's a lot more expensive than any other car of a similar type. It doesn't look great. And I don't know really how they calculated this, because obviously because of the VW brand it's quite difficult to calculate, but a simpler calculation has put the cost at another €2 billion for the company. So it's all stacking up. It's not great for VW and everything, but if we look at this sell-off, this had effect on the DAX as well. This helped lead the DAX lower, so we're going to take a look at that. So yeah, just like magic, here is the DAX, the J30 daily, and this is Monday. As you can see, the VW scandal hadn't broke. On the chart before, we showed that VW opened higher, and look, it's a big strong day, then bang bang bang, just like VW itself. Poor day, arguably other shares kept the DAX higher, but nothing can really fight against VW on the Wednesday. We've got a nice sell-off, just down, straight down like that. If we go back to the VW chart, as you can see, it's a very similar move. this is VW again, so bang, bang, bang. Kind of lower than Wednesday, just south completely. So yeah, how did this affect our difference indicator? So I'm just going to take you back to that now. Yeah, and as you can see, the overall effect was it made the J30 and the S&P 500 get further apart. So we move further apart. This was primarily due to the VW scandal. So yeah, there's a pull down. So it was a market moving event. It's good. So yeah, for the start of the week, there wasn't really big news, like other than data for the America, except the bonds. I think that's the underlying fear at the moment, so that's why I did that. But this is some releases that from the States that happened during the time. So we had the ISM manufacturing out 50, real 50.1 expected had been for 50, so a bit of a beat there. Red Book, yeah, I don't have expected for that, it's just the previous was 1.5%, so there's meant to be a percent there. And it was real came up 1.9, so that's a good growth. Factory orders slightly weaker, -1 compared to 0.9. Balance of trade better, -$40 billion instead of -$41 billion. And ADP employment change Wednesday. Yeah, real was at 182k and expected was at 180, so a bit of a beat, but yeah, cutting ahead a bit, it wasn't such a beat as the NFPs were. This wouldn't have given you that much hints. So, I mean, what did that really mean? So yeah, the Red Book, you've got to remember this is quite important because consumers are what's really keeping GDP alive in the States at the moment. Makes up around 70% of GDP consumption. So, and the Red Book is a measure of consumer spending. So, a rise of 1.9 is good. That's good for GDP, good for the American economy. Manufacturing, as seen by factory orders and ISM manufacturing, weaker than well, slightly better there, slightly weaker there. That's 50 for these are PMIs for this. Shows expansion, so we're slightly expanding. This is getting worse though. Imbalance, pretty much the same as previous release, but yeah, it's pretty mediocre really, not really that interesting. And once again, yeah, AD employment change, no hints. So how did this affect the markets? Let's go and take a look at the SPX 500. So Monday, yeah, this is the SPX 500 daily. So on Monday we had a rally. That was the day the ISM manufacturing data, although I think it would be a bit of a wild conclusion to say that caused this much of a rally. This was more of a risk on vibe. It happened across markets. So if you look at the J30 daily, as you can see, that rallied on Monday, a risk on vibe. UK 100, here you go, UK 100 daily. Sorry, we've got to zoom in on this one. This is Monday here. Yeah, so that was risk on. ISM manufacturing, not much effect. Let's go back to the SPX 500. Now Tuesday, I think it's fair enough to say that the Red Book growth to 1.9% from 1.5% did help lead this higher, because I think consumers key. I think it's one of the most important parts of the American economy right now, and if that goes to weakness, then you know they're in for some troubling rides, I think. But that's unlikely, especially with what happened later in the week. So yeah. And then also balance of trades and ADP employment out on Wednesday. We had this lower sell, but we sell off, sorry. But yeah, I mean, balance of trades has been consistently. It's been consistently expected that the dollar is going to affect trades more. Like always, expectations for trade is more negative than it actually is. So I don't think people took the better than expected results as bullish, because I think they just think like the dollar is really going to hurt the American economy. It's a constant theme. If you listen to any finance radio station, any kind of newspaper, it's a constant fear. So so for that, anything comes out, they're always going to take it as negative until the dollar weakens. And yeah, that ain't down, looking like it's happening anytime soon. So yeah, what we got was this. And yeah, I know we talked about the VW just briefly before, and that caused a sell-off. What we had, oh, sort of really apologise for that. Please ignore that. Yeah, and how that affected this. So it affected the DAX. Let's just bring that up. As we said, we bring it lower. That VW brought it low. It wasn't much moves, as I said before. We got a big strong risk on day, but we also had that on the JER. Big risk on, but it was really a fact that yes, we went sideways, innit? We had a bit of a rally, bit of a comeback. So yeah, that was that. That's why we had the coming back of the DAX and the SPX. So if we could just go back on that. So yeah, this difference between the SPX 500 and the JER. As you can see, they moved further apart as the JER 30 sold off a lot due to the VW scandal, whereas the S&P 500 rose because of the data, the red book data, which saw the SPX go stronger, and then a bit of negativity. But obviously there was much more negative news about JER 30, so they moved further apart, as you can see, and all that. So that's all good. Okay, now we're getting to the exciting end of the week, and that was Thursday and Friday. And as you can see, Thursday and Friday were very exciting. This is the pound dollar, so I've just flicked that out quickly, but this is the pound dollar daily, and as you can see, look at these moves. It's good stuff, man. So yeah, let's start off and talk about the BOE Monetary Policy Committee meeting. So Mark Carney and his committee sent dovish signals at the meeting this week. Although the majority of information released from the central bank was much unchanged, what really drove the market was that the Bank of England was using its ultra-low interest levels to predict the rise in inflation up until the spring of 2017, a whole year later than August. What this means is that the Bank of England cannot model a rate hike due to the probable reason that it would have negative effects on inflation rate. So basically what I'm saying is if the Bank of England use higher interest rates, then it would be counterproductive because it would just show poor inflation. So they're not going to model future inflation with a rate hike, because they won't do it, simply because it's just going to be negative for the economy according to their models. So they had to push that out to spring 17, which is a year later than previous, in August. And as you can see, big effect. If you go down on the hourly for the pound dollar, let's find where the release is. This is Thursday, so you know what I mean. Instant reaction, boom, 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 boom. This was Friday then. So this was the time the release, bang, bang. And it was quite straightforward for the pound dollar, because obviously they're not going to raise rates, so money's cheaper, weaker pounds. You also got yield in there. You know, you're not getting so much. The probability of rate hikes makes, you know, your yield going to stay less for longer. So we got a sell off, quite nice sell off as well, quite clean, I think. Move sideways here. So that was that. It was a bit more complicated on equities, so let's take a look at the UK 100. So yeah, this is the UK 100. And where was that? Where's Thursday? This is Thursday. Yeah, that's Friday. So this is Thursday. We've got a sell off. But let's look at the time of the release. Initially, you got a rally. Then we got a sell off. Got a rally, then we got a sell off. The rally is fairly intuitive, because money is staying cheap. Lower interest rates means borrowing costs are lower, so that means we can all go get a big bit of leverage and take as much risk for as little as possible. So we got a rally, people happy, but then down. Why is this down? Well, the reason is because it's not great for the English economy that they're having to model it up until spring 2017. Interest rates at ultra low levels. I mean, you can't say it's getting stronger if they're having to do this. You know, there are good signs from the English economy. Unemployment, for instance, is generally going down. It's being good, but it's not great, you know, and investors took it, so, and we got a sell off, big sell off, lower than when we opened. It moved slightly lower, but yeah, bang bang bang. Whereas the pound dollar, as you saw, just sold off. So, you know, how did this move affect the difference between the UK 100 and the SPX 500? So let's take a look at that. Yeah, so here's the S&P 500, and this is to take a look at the UK 100 and how they moved. As you can see, the S&P 500 only moved a slightly bit down, whereas the UK 100 sold off markedly. So that means we got further apart, as you can see. Further apart. So yeah, you can just juice that. Now this brings us on to the biggest news of the week, and it came out on Friday with the release of non-farm payrolls. Expectations for the release had been for 180,000, when in actual fact the figure that came out was 271,000, with previous having been at 137k. So that's big. I mean, we're looking at UK 100. So this is the S&P 500. Sorry, that is big. That's big news. Yeah, I mean, like people say, America maybe you've lost its jobs title. I know you can't take too much from one release, but its jobs machine title. But that's quite big. It's good. It's good news for the Americans, and they're all getting their jobs and everything, getting their paycheck. Happy days. But you know, we've got to ask the question: with such a massive beat, like, why didn't this really move for the whole day? Look at this; it's just completely flat. Like compared to other like days where there's not much news. Like, what's going on? Why is it not moving? I mean, that's not to say there was no movement, because there was some big volatile moves. I think it's SPX down onto an hourly. Let's take a look. So yeah, look at Friday. Look at the time of the release. Bang, huge sell-off. We all went all the way down there, and then look at this bar here. This bar as well. Look at this, shows the volume. Look at the top of the candlestick. It's up there. Whereas it closed down there. It went up there. Went a little bit down there as well. And same on the Wednesday. Not on the Wednesday. Sorry, in the next hour. Bang bang. Really flying around. But eventually we just came back up. Like nothing had really happened. Just went down and we come back up. So what's going on there? Wow, you know, we've definitely got two sides to the story. We've got some people selling, and we've definitely got some people buying. Well, it comes back to the discussion over the Fed, key institution, key player in this kind of action, price action, and this debate over cheap money versus economic data. So to start with the cheap money. Obviously the Fed's interest rates are ultra low. Yeah, and the release made it less likely that, more likely that they're going to raise rates in December. It went up to 70% afterwards, and that caused this sell-off. Bang. And then people started to balance this against good economic data. As you can, and basically because more people in work is good for the economy, more consumers, more orders, more everything. So it came back up, but for a little bit we just had huge volatility, you know, big time swings. It don't really happen that much. It's good when it does happen, it's good, but it's not. But there it was big volatility and everything. And yeah, this is a problem for well, I say it's a problem. It's an opportunity as well, for playing equities on a longer term basis, like I do for myself, because it's not great to have loads of volatility on the account. However, it did provide an opportunity on the currencies to hedge exposure, and what I did basically was bought dollar yen just in case the release was good, because it was short this, and I was a bit worried that it's going to come up. Yeah, so we bought it and we got a massive rally on that. I'll show you. So this daily chart, the dollar yen, that's what happened. No messing around really for the yen. For the dollar yen, it just boomed up, and we did buy it. We brought it down here, I'll show you on the hourly where we bought that like here. I think it was on this bar. Or this bar here. Just got that nice run up. I think we came out about here. Because once it was only to hedge the exposure to the event. So once the event kind of started to cool down, just got out kind of thing. Took a nice profit off that as well. So that was all happy days. Yeah. So what do we move on to next? Well, how is this going to play into next week? So we're going to start looking at next week now. Because as I said, if we look at the SPX 500 again, go back on the daily. For such a big event with so much news, we had not much movement. And as you can see, if you know your candlestick, this represents indecision. And I think this weekend is key. I think all the big traders, all the big long-term traders are going to be all huddled around in their meeting rooms this weekend, working out where do we go from here. So yeah, I got two charts of how this could move into next week. So let me show you that. So start off by showing you the S&P 500 and Fed probability. So the orange line is the S&P 500 and the blue line is the Fed probability. And basically the Fed probability did rise after the event. It rose to 70%. And the blue line once again is Fed probability, and this links to this line here. The lower the Fed this is the contract price. The lower the contract price, the more likely it is for them to hike when they work out the probability. So the lower the price. And as you can see, Fed probability usually moves before anything happens. Not always anything happens when it moves. So to say the probability has risen is not enough. And that's why there was indecision, because although there's more probability, the price of the contract is lower. There's not a key drive behind that, and that will be shown in my second graph. This one. This is the open interest. This calculates, this the blue line is the open interest, and it relates to this line, and this is the orange line. This is the XPX line, and it relates to this one. And as you can see, there's a much more direct kind of correlation. When one moves, the other one moves. Basically, open interest is a measure of how many people are exposing themselves to contracts, such as the one seen in this graph. So it's how many people are exposing themselves to these graphs. And as you can see, we didn't get the sell-off here. They didn't match. But when this moved, it moved down. So the contract got cheaper. People thought it was more probable, but they didn't actually hedge themselves. They didn't start exposing themselves to this contract. But once they did start exposing themselves to the contract, it zoomed up. As you can see, boom, up. And the SPX fell. So this is why I think this weekend is going to be interesting, because they're going to just start, big banks, big firms and everything are going to decide whether they need to start hedging themselves, or are they going to start needing to cut positions off from assets that are exposed to a rate hike. So it'll be an interesting one to see. So yeah, watch the open interest, watch the volume in that. And yeah, that basically brings us on to other events this week. So yeah, Monday we got the EU group meeting, and they're going to be talking about Greece and just general economic conditions and physical conditions, monetary, no, not monetary, must used to be physical conditions. Spain's also in the agenda, if you like watching Spain. Yeah, we got the Chinese inflation rate on Tuesday. It's important to note at this point, actually, we did have data out of China this morning, and that showed the balance of trade at 61.64 billion, and that was lower than expected. So remember, if we add that fact that China's got lower than expected trade data to what we discussed on this graph previously, the open interest, if people start hedging themselves, start open interesting this, and get a bit worried about the China trade data, could see some big sell-offs as we open. Something to watch. And yeah, China once again, Chinese industrial production on Wednesday 5.8, previous 5.7. Got unemployment rate from UK. I expect this to be quite good. It's my bias. UK is a good jobs maker at the moment. That's backed up by a lot of statistics and everything, so watch that. Yeah, so that's Wednesday. Draghi speaks on Thursday. And then I got Fed speeches with 2 exclamation marks for Thursday. The reason why is because there's a lot of speakers from Yellen, Bullard, Laker, and Fisher. And that's through Thursday afternoon, the American session, in a more generalizable way. So listen to them. Although, NFPs, you can't just take one kind of month. You kind of can as well at the same time. That's the problem. People can start expecting things off one result. So that's definitely going to be on the agenda. They will need to talk about that. People will want them to talk about that. So watch that. Good guide to what they could do in December. Friday, things from Europe. German unemployment expected 0.0 previous 0.4. Euro area growth rate 0.4 expected 0.3 previous. I got US retail sales 0.1. Previous was 0.3. That's a bit surprising to me. I thought the US retail sales would be higher. We could get beat on that one, but don't trade that. Do your own research and everything and all that. But yeah, that pretty much brings us to the end of this video. Thank you for watching. If you have any questions, comments about anything at all, please leave them. And I hope you have a good weekend. Thank you.